Hey, good afternoon. It's Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments for the 18th day of December, Thursday. One day left in the week. We've got a cattle and feed report tomorrow. We'll talk about that in a second. Major stories: no weather issue in South America. Good exports for corn and wheat. The market doesn't care. You've got wheat fighting for its life down here at contract lows. As far as soybeans go, when is it going to stop? My letter today was entitled "Was Enough Enough?" We've dropped $1.18 from the high which we had saw in January spot beans. Remember, we traded 11.69 and a half. Here we are at 10.51. We settled at 10.52 and a quarter. We are right on the 200-day moving average. Why does that matter? Because when there's no fundamental story, we start trading technicals. So this is a big level. Bullish or bearish, it's an opportunity. It just depends on what you do with it, right? I've been doing this for 30 years. I know these technicals matter because they attract opinion. What happens once we get there? That's always involves a second decision. And by no mean am I saying, by no ways means am I saying that technicals are the key to the gold, the goose that laid the golden egg. They're not. I wish they were. If they were, we wouldn't need brokers. We wouldn't need markets. We would just let the AI trade and just trade off these technicals. They are a tool. Um, just like anything, if you're a carpenter, you've got multiple tools in your toolbox. Sometimes you use a hammer, sometimes you use a jigsaw, sometimes you're doing something else, whatever you need. Um, it's not one's, there's no one answer, right? So I always get that pushback from people. But I learned a long time ago that these technicals matter and you want to use them to help you make decisions. That's really what it comes down to. And that's what I try and do. That's why I talk about them in my letter every day. If you like it, sign up for it. If you're curious, sign up for it. Take a look at it. I send it out every day. And that goes out 5 days a week. On Saturdays, I do a weekly wrap up. And then also once a week, I do a private client podcast where I spend 20 minutes, 25 minutes going through and talking about the technicals and talking about what it is I'm looking at, trying to explain to guys who want to learn. All right, big picture. March corn finished the day up 4 cents at 444 and a half. It's kind of weird. You got four fours there if you're a numerology person. Jam beans down 6 cents at 10.52 and a quarter. Again, it's right there at the 200-day moving average. Very key level here. We've dropped $1.18, almost 6 grand a contract in just 4 months, right? I think enough is enough. We'll see. That was the title of my letter today: is enough enough? The market's oversold. I'm not saying it can't go lower. I'm not saying buy calls and retire. But boy, if you had puts on the rally, right? Roll those things down, get paid, right? Nobody that I work with paid more than 10 or 12 cents for a bean put. Maybe some guys paid 15, right? Max. Those have all gained a ton when the market moves lower like this, puts gain in value. So you have to manage them. No two ways about it. Just the same way you have to manage them on the way they go when they're on the way up. You can roll them up. You need to roll them down when the market allows you to take money off the table. I saw one social media post where the guy was saying if you bought this put for 16 cents, now it's worth 25. Yeah, because we rallied at $1.20 once you put the original put on. And if you did not roll up that put, then yeah, you did not participate in the rally. I'm just like, you gotta, a hedge is a hedge is a hedge, right? Now, if you sell the board and then the market rallies at $1.20 or $1.30, you're making margin calls and you've also locked in that floor down there. If you buy a put, first of all, you've got to realize that if you spend 12 cents on a put and the market rallies at $1.30, you got a 10-to-1 payoff on the value of your put. So yeah, you want to roll that thing up. Yeah, it means you're gonna have to sell one and buy another. Yeah, it means that a broker is gonna get a commission. Or if you want to do it yourself, get yourself a discount broker. You're still gonna have to pay somebody to buy an option and sell an option. There's always a cost doing that. But you've got to manage these options. That's my bottom line. And if you know how to do it, great. If you're looking for help, that's exactly what I do. And no, I am not perfect. I am not psychic. I am not, I'm not George Soros. So don't give me that. But I can do a lot better job than 95% of you guys out there. especially if you're trying to run a farm, raise a family, do 1,000 other things. If you don't have time to sit in front of the screen and say, what should I do? Or at least you want to be told this is a possibility. If someone says we should roll this put up and you say no, fine. But at least you had the opportunity to do it, right? That's really what we try and do. You want to look for opportunities. Same thing right now. If you happen to have bought a put for 25 cents when we were on our highs and now it's worth $1, if I was you, I'd roll it down and get paid and have a cheaper put on the floor. Now, if you don't want to do it, that's fine. But based on all the things I've learned in 30 years, a big part of managing options is adjusting them when it makes sense. And I'll just leave it at that. Crude oil sitting here at 56 bucks. We're still near 5-year lows. We traded under 55 bucks the other day. We're at 56.15. If you want to call that a rally, if you want to say the blockade on Venezuela is the reason that that's a rally, if that makes you feel better, God bless you. I don't. We are digesting these 5-year lows. Now, what's the silver lining to the fact that crude oil's at 5-year lows? Well, diesel fuel is down to 6-month lows. So if you use a lot of diesel, we're at 212. Literally 3-4 weeks ago, we were at 270. So that's got to help somebody. And can we go lower? Yeah, we can go lower. Absolutely, positively. I'm not saying that, but if you use a lot of diesel, this is a gift. Take advantage of it. You know, do some hedging, buy some actual product, whatever. You're a lot better off than you were 3 weeks ago. And we're going to see, that's also a impact for the overall commodities index. Crude oil is a big driver there because that's a main part of the whole value of the entire commodity basket is crude oil. So the ethanol math problem works a lot better when crude oil is at 65 or 70 than it does before at 55 or 50. So that's going to influence corn prices. It's also going to influence what you've seen it right now. The EPA kicked the can on the biodiesel regulations. Market did not like that. The funds were all long bean oil. Why do you think they were long bean oil? They thought there was going to be a big announcement and bean oil was going to be going higher. Now they're all long and wrong. So yeah, they're getting out of that position. That's pushing the price of bean oil lower. It's something we watch every day. So the whole crush complex moves together, bean oil and meal. You've got meal here at 2-month lows, right? We dropped 30 cents here on this break. We've given back half of the rally. Now, is that something that if you're an end user, you want to take advantage of? Possibly. When we're at multi-month lows like this, if you use a lot of meal, take a look at it, right? And again, no, I'm not calling it bottom. No, I'm not saying give me $100 and you'll make $1 million. That's not what I'm saying. I'm saying if I'm an end user and I use a lot of meal, maybe you didn't notice it, but meal just dropped a lot in value and you might be able to get some better deals on your inputs, period. In the wheat, we managed to finish a penny and a half higher, but we're still battling it out here at these contract lows. March wheat finished at 507 and 3/4. If we take out $5, it's going to be nasty because it's going to be all over the Wall Street Journal. If you look at Kansas City had a good spike. The contract low in KC March is 498. We're trading at 517. So that's a good thing. You've got some bottom fishers coming down here. Is this going to be some sort of double bottom 6 months from now? Or is somebody going to be writing a book saying, how I turned $300 into $3 million trading wheat? Possibly. I don't know. But I know one thing, $5 has got to hold if I'm long wheat. If I'm storing wheat and I don't have a put, I want to put on that's as cheap as possible. Moving over to the livestock. Kind of a whippy, garbagey day. We've got a cattle on feed coming out tomorrow after the close. So Monday, Tuesday of next week. If I've got hedges on now, you can do weekly options now in the fat cattle and the live cattle. You don't have to go by 30, 40, 50, 60 days. You can buy a week or two of protection. So that might be something you want to do, especially because, when you're looking at fed fat cattle at 228.40, which is where we settled today, down $1.10, that is still way, way, way better than where we were at 204, right? What's $24 worth to you on a potload of cattle? What's that worth? You have to tell me. I think it's worth, doing something. It's a good chunk of dough. It's definitely worth having to put on, even if you just keep it on for 2 or 3 days for the report. If you look at March feeders at 334.60, yeah, it's a little bit lower here, $1.70 lower, but on another $6 trading range. Big picture though, at 334, the low of the move was 293. So what's that 40 plus dollars worth to you? You know, what's that $20,000 plus worth to you from a revenue standpoint with those animals? I'd say it's a rally that you want to try and capture the value of the rally as much as you can with a hedge. Now, I was talking about rolling up puts. I had puts on that we spent 5 cents for originally. The market rallied $40. I was able to spend $2 and move the floor up $15. I went from 290s to 305s. So there's a situation where we spent $2 to roll our floor up $15. Does that make sense? I don't know. I'll let you know. A month or so from now, or if we're back down, sub 305, then yeah, it's going to be a great thing. If we go from 305 back to 290, and we bought that $15 for $2, that's going to be a good hedge. If cattle keep going higher, great. You spend $2 and the market continues to go higher. So that's how we roll up options there. And again, it's not complicated. Nobody's reinvented the wheel here. But a big part of this is just staying on top of it and at least knowing what's possible if you are interested. That's the nice thing rolling on options. Nobody's forcing you to do it. If you sell the board, if you get short futures, you're sending margin money in. No two ways about it, or you're lifting the hedge. If you buy a put and the market rallies $40, you're not sending any margin in. And then you get to decide how much of that $40 do you want to try and capture and how much is it going to cost. So that's why I think a put option strategy is the best option for most producers, because most producers, you're already stuck one way. You're always stuck back long. And what you want to do is when you get these $40 rallies, you want to capture as much of the revenue as possible. Why? Because if something changes, they open up the border, somebody says something, some headline comes across. Yeah, you're going to be mad, but you're going to be less mad if you've got a much better floor underneath your animals. So that's why we roll the puts up. No, it's not a guaranteed path to riches, but I can tell you one thing: it's nice to have a floor. It would be nice to have a floor here at 330 if next week we're trading at $3, right? Wouldn't that be nice? I think so. Now, if you spend a little money and then the market goes from 330 back to 360, are you going to be mad? Probably not. If you sell futures here at 334 and it goes to 360, you'll probably be irritated because you'll have capped your floor at 334, and you've also made margin calls for $30. So that is the strategy there for using options. And like I said, I've been doing this for 30 years. If you know some other strategy that's better, let me know. We can write a book and you can build a whole risk management profile on it. And if your risk management strategy is just betting your gut, good luck with that. Moving on with the lean hogs. Lean hogs have had a good recovery. So we're sitting there at 88, 89 cents in April. There's a lot of resistance at 90 cents. Again, I would love nothing more than to buy put here for 3 or 4 cents and have April hogs go back up to 94, 95, 96 cents. I'd love to spend 2 or 3 cents on a put and have the market rally another $7 or $8. What I don't want to do is sit here with us sitting here at 89 cents and something happens and we're back sub 80. So that's, again, it's up to you. How much of the $9 do you want to try and defend? If you don't want to defend anything, then don't. It's okay with me. Okay, well, that's my 2 cents for this Thursday. We'll see what happens tomorrow, Friday. This is Chris Robinson, 312-638-8868. Give me a call. Take care.